So let's get started talking about technical analysis. Now, this is a field that a lot of people get confused with and they get intimidated by. Now, tonight in our class, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, CFDs, cryptocurrency. You know, it gets very boring just saying asset, 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 or security, security, over and over and over again. So even when I use the term shares, or I use the term Bitcoin, or I use the term CFD or gold, I'm just trying to make it a little bit more interesting. We're not talking about just gold. We're not just talking about just CFDs, because everything we're going to discuss tonight will fit all the open markets. So similarly, I also intermix the term investing and trading. Now, typically, an investor takes a longer-term position, while a trader takes a much shorter-term position. And because we're all traders on EDX, we're trading CFDs, and we're trading in short-term positions, or we're therefore traders. But again, it gets very boring just saying trading, trading, trading. So I go back and forth between investing and trading. But it doesn't matter. Both of these concepts, or any concept we're talking tonight, is just fine for either one. Now, the ultimate question comes back that traders are always looking for answers to: should I buy today? What will prices be tomorrow, next week, next year, or even 15 minutes from now? Would investing be easy if we knew the answers to these seemingly simple questions? Now, if you're attending this class in the hopes that technical analysis has the answers to these questions, I'm afraid I have to disappoint you early. It doesn't. I don't have a crystal ball. I don't have a Ouija board. None of us do. So technical analysis no kind of analysis is going to tell you what tomorrow's prices are, or what the price will be even, like I said, in a half hour from now. But if you're attending this webinar with the hopes that technical analysis will improve your investing or trading, I have good news for you. It will. Now, the term technical analysis is very often misunderstood because it sounds very complicated, and most of us automatically think that it applies to RSI, stochastics, MACD, moving averages, and then complex mathematical formulas that give us algorithms or give us these indicators or oscillators. But that's only one tiny small part of technical analysis. Technical analysis could be just simply called chart analysis. But anything we do, from looking at a simple line chart all the way up to applying elaborate strategies, all falls under the field of technical analysis. Now, there are many different sectors in this field of technical analysis. So when we talk about these complicated mathematical formulas, they're usually what we call technical indicators. But then we have things like chart patterns, which are triangles and bull flags and bear flags and pennants and wedges and head and shoulders. And these are chart patterns. But also we have Japanese candlesticks or candlestick charting. That is technical analysis. Drawing a trend line on a chart is technical analysis. Now, the roots of modern day technical analysis stem from Dow theory that was developed around the 1900s by Charles Dow. So all of this technical analysis came before we had online trading, came before we had computers, came before we had all of these advanced type charting, came back from the old days when people used graph paper and drew their charts and put their prices on a chart, and data was hard to get. So you'd have to get, when I first started trading over 40 years ago, we got it off of ticker tapes. And we'd have to sit in brokers' offices using their ticker tape or their display to see what the prices were of an asset. And again, there was no online trading. Everything was traded directly through a broker and traded in a pit. But now Dow, Charles Dow, and you know that name, you know why? Because you know the Dow Jones Index, which is named after him. Dow, has become a very, very famous or very well-known name in this field. But this was all done in the 1900s. But his theories or his principles started as the trending nature of prices. Prices discount all known information, confirmation and divergence, volume, okay, and support and resistance. Before Dow came up with these principles, we basically all traded from fundamental analysis. We traded, and we didn't trade. Our fathers and our grandfathers didn't trade, but the brokers and the pits traded from fundamental analysis, news and headlines. When you were trading coffee or corn or wheat, you'd be trading from the USDA agricultural report or for the weather reports. Ours used to go through the ceiling, up and down, as the prediction from hurricanes would be coming into Florida. Okay. But this is all anybody knew. Nobody had real charting knowledge. Nobody looked at charts to see where a price might go, what volume would be affecting it, because the markets moved a lot slower. Now, Charles Dow's contribution to modern-day technical analysis cannot be understated. His focus on the basics of security price movements gave rise to a completely new method of analyzing the markets. Now, we use this big term called technical analysis that sounds like it's scientific. Sounds like it's, we can punch these numbers in a computer, put these lines on a chart, and we know exactly what to do. Well, if the world was that easy, we'd all be rich. But the fact is, the human element and psychology and human psychology play a huge part in price action and prices. And this cannot be predicted. So even though technical analysis really tries to look at what this human element is doing. It tries to understand the psychology of the markets and tells you where the mass of the markets is going. So the price of security at all times, whether you're looking at gold, whether you're looking at oil, whether you're looking at Bitcoin, okay, whether you're trading the euro, represents a simple consensus. It's a price at which one person agrees to buy and another person agrees to sell. The price at which an investor is willing to buy or sell depends primarily on his expectations. If he expects the security's price to rise, he will buy it. If the investor expects the price to fall, he will sell it. Now, these simple statements are the cause of major challenges in forecasting prices because they refer to human expectations. As we all know firsthand, humans are not easily quantifiable or predictable. This fact alone will keep any mechanical trading system from working consistently. And because humans are involved, I am sure that much of the world's investment decisions are based on irrelevant data. Our relationship with our family, our neighbors, our employer, the traffic, our income, and our previous success and failures all influence our confidence, our expectations, and our decisions. Okay. Now, you think that's all crazy. But the fact is, if you were a big hedge fund trader or a big bank trader, and you were responsible for the euro, and you're trading billions of dollars in euros, and there's an accident on the highway, you got to work a little bit late, you were rushed, you were running around, the coffee spilled all over, and you're going crazy, you might not make a trade that you would have made normally because you were just too hectic this morning. Or you had a fight with the wife and you're in a bad mood and you just can't get it out of your head. And you're trading billions of dollars. Doesn't mean you lost any money, but it doesn't mean you made a trade that possibly made money. That affects the price of the asset because these big block trades and these big commercial trades have an effect on the markets. But security prices are determined by money managers and home managers, students and strikers, doctors and even dog catchers, lawyers and landscapers. The breadth of the market participants guarantees an element of unpredictability and excitement. The fact is today, the world has changed immensely since I started trading because in my day, there weren't many traders. We were all professional traders, trading in pits or trading at brokers' offices. The world moved smoother, and in fact, most of us that were trading in agriculturals knew each other. We might not have ever met, but we knew each other because if you didn't have, you had to have a fairly large account and be stable because there was nothing of this online trading. There was no telephones you could call a broker and say, buy me 2 contracts of hogs. Buy me, 10 bushels or 50,000 gallons of orange juice. Okay? Didn't work so easily. Couldn't open an account that quickly. Sure, we didn't have all the stuff like we have now with computerized ID matching, and we didn't have, terrorism and anti-money laundering laws, but you still couldn't even get the money to get an account open with a broker till your bank sent a wire and he had the money in the account. And that would take, in those days, a wire could take 3 or 4 days to be, get where it's going and another 3 days to be posted. Things moved a lot slower. So the markets had less unpredictability because we all knew what we were, we could kind of predict what the guy in, the other side of the country was going to do also because we kind of knew each other. We were looking at the same data. Today, we have so many players in the market, whether it's you guys sitting out there attending tonight's webinar, whether it's the guy who's, raised, a couple $100,000 between his relatives and he's trading the euro, at his home. There's all the brokers, all the online trade. There's so many participants in the market. The human element takes a big chunk of this. Now, if prices are based on investors' expectations, then knowing what as assets should sell for, which is basically fundamental analysis, becomes less important than knowing what other investors expect it to sell for. Now, that's not saying that knowing what a security should sell for isn't important. It is. But there is usually a fairly strong consensus of an asset's future earnings, and the average investor cannot dispute. Now, the fact is, none of us really care in our type of trading what the actual value of Apple shares are. We don't need to break down the corporation, see what all his assets are, what his sales are, do all that type of analysis, because we're not looking to buy Apple, sit on it, and hold it. We're looking for Apple to either bounce up a little bit or fall down a little bit so we can make some profit. Okay? We don't care what the long-term outcome is going to be for the euro based on Mario Draghi's decisions. We only care how it's affecting the euro now. We don't care if the euro should be valued at 114. Okay, and it'll finally find 114 next week or the week after. Don't care. We care that the euro is at 113 and it should bounce up to 113.5 sometime today and fall down to 112.98 today, because we're trading in a very short-term world. So we're less concerned with what an asset's true value is and more concerned with what its value is at the moment and which way it is moving in the short term. Now, I hate mentioning ever casinos, gambling when I'm talking about Forex and CFD trading because it's a world apart. But tonight, I'm going to use a perfect example, and it's got nothing to do with you playing poker. Okay, it's not about gambling. In my experience, only a majority of technicians can consistently and accurately determine future prices. And there are very, 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 very few. No matter what type of strategy you have, no matter how experienced you are, no matter what kind of computers you're using, what kind of scanners you're using, what kind of robots you're using. Because you know what? If you could predict the markets all the time, then those hedge funds should be making tons of money and never place a losing trade. If they never place a losing trade, you could never have a winning trade. But it doesn't happen that way. So even if you're unable to accurately forecast prices, technical analysis can be used to consistently reduce your risk and improve your profits. Because what it's all about, and that's why risk management is so important, is making sure your risk is at the lowest point possible and that you can get the most profit out of your trade. So you don't care if you have 4 or 5 or 6 losing trades, as long as your next profitable trade covers your losses and makes you additional money. So the best analogy I can find on how technical analysis can improve your investing is a roulette wheel. Now, I use this analogy with reservation as gamblers have very little control when compared to investors. Although considering the action of many investors, gambling may be a very appropriate analogy. But we're not looking at the roulette wheel from the gambler side. We're looking at the roulette wheel from the side of the house. And the house is all about statistics, mathematics, and profit. So a casino makes money on a roulette wheel not by knowing what number will come up next. They don't care how many winners and how many losers are at the table, but by slightly improving their odds by the addition of 0 and 00 to the wheel. Do you realize that? That by adding, originally there was no green 0 and 00. When they added the green 0 and 00, that improved the odds of the casino. And that's all they're doing is looking at tipping their odds because they know that they need to make 5% on every trade that's placed. Okay. So they need the odds slightly in their favor. So by adding 2 more numbers, taking them away from the red and the black, and adding 2 numbers that are at the far end. Now, granted, it pays a lot of money, 35 to what is it? I think 35 to 1 odds. But it's all about moving things in the favor of the house. So if you think that at all times you're the house and you're only going to make trades with high probability success ratios and low risk ratios, so in other words, high reward, low risk, you're moving things in your favor. And what technical analysis is your tool to analyze and only make the trades with the highest probability of success. So similarly, when an investor purchases a security, he doesn't know what the price, if the price will rise. But if he buys a stock when it's in a rising trend after a minor sell-off and when interest rates are falling, he will have an improved odds of making a profit. That's not gambling, it's intelligence. Yet many investors buy securities without attempting to control the odds. So, contrary to popular belief, you do not need to know the security's price will be in the future to make money. Your goal should simply be to improve the odds of making profitable trades. So even if your analysis is as simple as determining the long, the intermediate, and the short-term trends of a security, you will have gained an edge that you will not have had without technical analysis. Okay. So remember that too many people want to get these complicated, involved strategies on their charts. And they use so many things that they get lost. Because the fact is, if you minimize your risk, you maximize your profit, you always use the right rules, leave your emotion out, you will be successful. Okay. So what you're doing is you're looking for some type of a trading edge. And that is your strategy. And that comes from technical analysis. Now remember, technical analysis starts with just looking at a price chart. Because price action is the ultimate winning factor, the ultimate factor, because no matter what all your other analysis tells you, the only thing that is really true is the price. And if all your analysis tells you something's going to go up and it goes down, it's only the price action on the chart. So if we accept the fact that human emotion and expectations play a role in security pricing, we also have to admit that our emotions play a role in our decision making. And this is why technical analysis becomes very important. Because technical analysis tries to remove your emotion from your decision making. Because now we can't take it all out, because if we took it all out, then we could say that mechanical trading systems could help us. But again, because we can't take out the human element of the rest of the world, we just want to take our own out. But that's why automated trading systems don't do too well, because they cannot forecast the human emotion and predict the human emotion. But what they can do is limit your risk, maximize your reward, but they don't do any better than you do if you use your own little system and follow your rules. Now, the fact is, Computers are a wonderful thing. They give they give both of us an edge. It's put us equal with the brokers. It's put us equal with the commercial trade because now we can get all the data and analyze it. We can use scanners just like they do. We can use some type of automated trading or robotics. We can generate signals like they do. We get the economics counter, and we have the charts that are up to the second, as advanced as we can get, that are getting data fed as fast as they're getting. And it will allow you to watch a lot of the market from your own little desk in your own little house. Now, technical analysis is based almost entirely on the analysis of price and volume. So when you stop to think about it, every bit of technical analysis, whether you're looking at a chart, whether you're using RSI and stochastics and Fibonacci retracements and all this other things, and a head and shoulders pattern with a double top, and you got your Japanese candlesticks out there and you're looking at a bullish engulfing pattern. Fact is, every bit of that stuff I just mentioned uses the same exact data because all you have is the high. You have 4 pieces of information. You have the open, the high, the low, and the close for the price, the time frame you're looking at, and the volume. So every indicator, every piece of analysis is all based on those same numbers. So nobody's getting other numbers from somewhere else. They all come off your price charts. Now, let's go over and take a look at a chart. Let's start seeing what technical analysis would look like on a chart. So what we got in front of us, as soon as it pops up, there we go, is the standard chart that I use for a class, and that's the Euro-US dollar 30-minute chart. Now, tonight, I'm not going to teach you all about charts because we have, in fact, I think it's next week, we start our 3-session class that we start out, and the first class is understanding charts. From there, we go to support and resist trend lines and support and resistance and volume. And we have break it all down because those are the basic foundations. Okay, but we're looking at a Japanese candlestick chart right now. Now, this has become the favorite type of chart for online traders. Now, there's some fallacies with it because most of us think that the reds and the greens, not most of us, most of you guys, think the reds and greens tell you whether a price is going up or down. That's got very little to do with candlesticks. Candlesticks are about 32 main pattern formations that exist between the previous and the next candle and the candle before, as well as the body, shape, and size of each candle and the length of the wicks. And there's names for some candlesticks like Doji, Evening Star, 3 Black Soldiers, 3 White Crows. There's bullish engulfing and bearish engulfing candles, and you have to learn all those to really be able to use Japanese candlesticks. And we have a very good class on the basics of Japanese candlesticks. And we teach it every month, so you should come to that. But we have 3 basic types of charts, and we're looking at candlesticks. Now, the real basic type of chart is just a line chart, which really gives us very little information. It just puts a dot on the chart because I'm looking at a 30-minute chart. Every 30 minutes, it puts a dot on the chart at the close of each 30 minutes. Back in my day when we first started trading, the most popular chart, and still my favorite for trading, is let me just change the settings to correctly here. Our bar chart. Now, bar charts used to be just black like I just said for you. Okay. Because reds and greens in a bar chart just make it virtually a Japanese candlestick. But a bar chart gives you 4 pieces of price information. Okay. Gives you the open, the high, the low, and the close for the asset. And allows you to easily visualize price and price movement. Because if I were to tell you that the Euro-US dollar is trading at 114.771 and it was at 114.772 as 30 seconds ago, it was at 114.778 8 minutes ago, that's too much for your brain to just see. But if I were to put it on a simple little chart I give you the bar chart that showed you the open, the high, the low, and the close, which is all the activity for the, in this case, the euro US dollar for 30 minutes. I've seen it all. I can see it all. I visually recognize it in my head and work with it. Okay. Now, there is no difference whatsoever between that chart and this chart because price is price. And if you notice, there's some similarities because the Japanese candlestick uses the same 4 pieces of information, the open, the high, the low, and the close. But by just simply looking at these charts, we started doing what's called technical analysis. Because anything you do with a chart is the field of technical analysis. Otherwise, you're usually in the field of fundamental or qualitative analysis. So fundamental analysis is news, headlines. But you know what? You can trade really well when, Google or Apple's, has some headlines or some, made some press or released their earnings figures, released a new mobile phone or new invention. Okay. Well, you can say, yeah, Google's going to go up. Google's going to soar. But does that help you say what price you should enter and buy Google? Where you should put your stop loss? What your target profit, what your target point should be so that you can properly assess your risk-reward ratio? Or does it even tell you when the market's turning against you? Or maybe the market had predicted that news already and is already incorporated in the price? No. The only place you can get that information is from your charts. So therefore, whether you want to be a technical analyst, okay, using all kinds of indicators and oscillators and patterns to predict price movement, you can still use technical analysis because you have to learn to read a chart. And that's one of the reasons you should come to our class on charts. Now, we have all kind of advanced, complicated things called technical indicators. Some of them go on our charts right over top of price. Like here we're looking at Bollinger Bands. Or some of them get put below our price charts. And these are called indicators. And some also get dropped right on to the charts. Okay. Now these are all complicated. These are all mathematics. Some are simple, some are complicated. Some are quite involved. Reading them and knowing how to read divergence, how to get transaction signals, what overbought and oversold markets tell you, are complex. Reading these charts and reading the indicators can be difficult. But you can learn. You don't have to use hundreds of them. But you can start out, and that's a whole field of technical analysis. Now, every trader needs to be able to look at a chart and see what price is trying to tell you. No, you don't have to use these complicated technical analysis tools. But once you've looked at a chart, you then have to learn how to determine what a trend line is and how to properly put a trend line on your charts. Do I put a trend line under prices? Do I put a trend line over prices? What rules do I have to draw a proper trend line? Because you need a valid, accurate trend line that can help tell you what the market's doing. And if you've ever been or you've been in the markets for any length of time, you know one of the oldest adages is the trend is your friend, or the trend is your friend until it isn't. But statistically, and not all, but most successful traders will tell you that trading with the trend will generate you more profit than trading against the trend. You can make money trading against the trend, but statistically, you will eventually make more profit trading with the trend. Okay? Because it takes a lot of action to push price either up or down. So prices tend to want to trade sideways or in congestion. But when you get a good trend and you can see that trend, whether it's up or down, you can make smart trading decisions. But that is also technical analysis. So we can see on this chart here that I just popped on the screen, this is not so complicated. This is simply a Fibonacci table over here giving us retracements. We have a chart pattern, which is called a triangle, and we're looking for a simple breakout of that panel. And down below, we're using RSI. This is a fairly basic trading system that's not overly complicated, not using too many indicators, too many technical analysis tools. Okay. Here we have a very easy decision-making capability. This is using what we call chart patterns. Chart patterns are extremely popular, are extremely well-known, as one of the things I trade from. And this is when price forms a triangle, forms a wedge, forms a head and shoulders pattern. When these patterns develop, they're actually interpreting the psychology of the markets. And by seeing how historically traders traded when a price moved into a triangle, you can then decide how to trade this pattern. Because a triangle doesn't tell you necessarily whether price is going to break out, up, or down. Okay. But we get, as the price gets pushed into the apex of the triangle, we know at some point it's going to break either up or down. Okay. When it does, we can actually calculate the momentum and then figure out how far it should push that price. But we know as it gets pushed into the center of the triangle, it's going to make some type of a move. By combining that with support and resistance levels, we can make an intelligent trading decision. And we can interpret the markets without being that complex. Okay, here's a very simple one using a channel, which is a chart pattern, and our support and resistance lines. And here, I've even put on here your selling trigger and where your target would be. And see how the target is tied back to the initial point of where the channel started. And this is where we got the rejection when it broke out of the triangle and where price violated the support level. I don't expect you to know any of this, but this is not a complicated system. This is not something that would take you a lifetime to master. Okay. And here we've added one indicator down below called RSI, and we're seeing something called divergence. Okay. We have whole classes on divergence. We have classes on support and resistance. We have classes on chart patterns. But you don't have to have overly complex systems. Here's a very easy system, trading decision-making, using support and resistance and Fibonacci retracements. Okay. Very easy. Something you could master in no time. Support and resistance. And we're going to talk about trend line support and resistance a little bit more tonight, because these are the backbones of technical analysis. No matter how you're going to trade, be able to read a chart, add a trend line, and find support and resistance. Support and resistance are prices that historically have been very important as this asset has moved through those prices. So in other words, we're looking right now at the New Zealand US dollar. We have our first support zone at 0.67145. Where does that come from? The last time price was in this area, it had a lot of reaction at that 167.45. And historically, prices always had to stop at that price. This is just a price that psychologically traders have stopped and hemmed and hawed for a second. Okay, our resistance is when price is moving up. This is a price where it had a problem pushing it through in the past. So there's a good chance that it doesn't mean it won't go right through it, but there's a good chance as it approaches that price level that all the traders, because these aren't secret prices, as all the traders around the world are seeing that, they're hemming and hawing. They're trying to decide what to do. So when we know what can happen and what to expect, we can then make some decisions. Fibonacci retracements. Fibonacci is a tool that you drop on your chart, which measures the move of the prior trend and gives you retracement levels. Because remember, prices can only go up and they can only go down, especially in Forex. When a price goes up 100 points, it will usually eventually come down that 100 points. So you take the prior move up, you break it down into percentages using the Fibonacci tool, and it's not going to tell you it will or it won't. It's going to tell you points that you should be watching. And this is simple technical analysis, okay, without any complex stuff. So I put a little presentation together for you on trend lines, which should be your first step in understanding technical analysis. And let's take a look at that. And then we're going to go over and look at, and then we're going to go over looking at how to put it on the ETX trading charts. Now, one thing I want to point out to you on charts. Now, tonight we're using TradingView for our charting. But it's very important to remember that if you're trading, you either need to be trading using a charting service that you're paying good money for, or using the charts on the ETX platform. Because free charts and cheap charts, they're all price is always the same. But like all the free charts, if you got a free tradingview.com, tells you there's a delay in prices. Because the feeds that feed these and the servers and all the other stuff, the streaming, is very expensive. So if you're not paying anything, it's giving you a delayed feed, not to hurt you at all. It costs the provider a lot less money when he's giving delayed feeds. The provider charges less money. And fees, like I said, are very expensive. When you're paying for an account with TradingView, you'll get them up to the minute or up to the second. When you're trading on the ETX platform, you're getting them instantly because ETX, the charts come from the feeds for the prices, which are instant feeds. They're paying the highest amount because brokers pay a huge amount of money for this. Whether they're providing you charts or not, they've got to pay for that data coming in to give you trades. So their charts will be the fastest, most accurate, and most up to date. So let me share with you this presentation. No, we'll explain trend lines in great detail to you in our class on trends and trend lines coming up next week. But you have to learn how to draw them properly. But a trend line is the basic backbone of technical analysis. Because technical analysis is a study of historical price action in order to identify patterns and determine probabilities of future movements in the market through the use of technical studies, indicators, and other analysis tools. Technical analysis boils down to two things: identifying trends and identifying support and resistance through the use of price charts and other time frames. So what I want to do is right now share with you how to do this and use the charts and put these lines and these indicators on your charts on ETX. So we're going to share this presentation with you. And then So as you see, the charts on ETX are as advanced, if not more advanced, than the ones on TradingView that we've been looking at, and the data feeds are ultimately faster. Now, you saw it on the black background. Not all of us like black backgrounds. You can choose the black or the light, the dark or the white. on the whether you're trading or using the charts on the ETX Pro trader platform. Now, technical analysis, whether you're going to use it as your primary decision maker, cannot be ignored. Now, otherwise, you're just guessing, because technical analysis of a market can help you determine not only when and where to enter a market, but much more importantly, when and where to get out. And getting out is sometimes more important than any other decision-making process you're following, because getting out when the markets move against you with the smallest risk possible, smallest loss possible, is very important. Or getting out when you've made, the profit you wish to make, or knowing that the market's about to change against you, so you want to close your trade and book your profit. So you'll only get this from technical analysis. So remember, there is no magical combination of technical indicators that will unlock some sort of secret trading strategy. Believe me, there's all types of gurus. I'll warn you now. There's all types of gurus out there trying to sell and trade and get you to do everything. They've developed some system, and if you follow this indicator and that, and then adjust it and customize it this way, you'll make tons of trades, and you make all this money. Well, they could use that to make all that money. Why are they wasting their time trying to give it to you? They'd be trading and making a fortune. They'd be billionaires and not bother with us. Warren Buffett doesn't sit there and tell you how to trade. So remember, the secret of successful trading is good risk management, discipline, and the ability to control your emotions. Anyone can guess right and win every once in a while. But without risk management, it's virtually impossible to remain profitable over time. So since chart watching is not infallible, an even more important aspect is that it will tell us quickly if our assessment of the market mood is incorrect. Basic chart analysis is relatively easy. So while professional technical analysts have dozens, if not hundreds of tools at their disposal, it all boils down to 3 steps. Seeing where the security is currently trading, figuring out how it got there, and determining the power of the trend and making comparisons of the asset to its peers in its own industry or even its own history. To do all this, all that is needed are these key technical analysis tools: trends and trend lines, and support and resistance. Okay. The rest of it you can add and do whatever you want and build your own strategies. But also volume is very important, because volume will help you see what all the other traders around the world are doing. And maybe if they're doing the opposite of what you think you should be doing, maybe you should stop and think. So remember, it's a step-by-step process. And now that you have the theory and the tools, it's time to take your next step, moving into decision-making and buying and selling. It doesn't have to be complex, but start somewhere. Start looking at your charts. Start being able to see something happening in your charts. Okay. And on that note, I'm going to say goodnight to y'all, and I hope I see you in our Basics of Your Trading Foundations, class number 1, Understanding Charts, class number 2 next week, also on Trends and Trend Lines, and class number 3, Support and Resistance and Volume. But we have all kinds of classes for you. This doesn't have to be an instant process. It doesn't have to be something overnight, because if you set something very easy, okay, and start out with something easy, you can still get master that. You can add more and more technical analysis on, because all we're doing is trying to find trading candidates, because ultimately it comes down to risk management. So if the asset passes all 3 tests, set up some tests. Support, is it trending? Is it reaching a support line, bouncing off and falling above? And decide whether it's just an appropriate candidate to trade. Then apply your risk assessment and determine whether you can make that trade, because risk management will in most cases throw most of your trading decisions out the window. Because when you see that in order to trade the euro today and do what you think it might do, you've got to put your stop loss at 113.50, because the swing of the market is so far, but you figure out with your risk reward ratio, you can't afford, and your money manager, you cannot afford to make a trade that has that much risk involved. So therefore, you don't make that trade. So it really comes down to some very important factors. So please look at technical analysis as simply looking at a chart. Get used to looking at your charts. Don't make it complicated. You know, even if you just want to start off with Japanese candlesticks, at least learn it inside and out and become an expert, and then go on to the next. The easiest thing to learn are support and resistance trend lines and volume. You can master those in no time at all, and then start building your foundations and your trading strategy. So thank you very much for joining us tonight. We'll talk to you again real soon, and have a great week trading. Bye now.